Today, let's answer a very important question, especially when you're building your wealth towards financial freedom, financial independence. You will come to this crossroad of whether you should put your funds in CPF first or you should divert your funds into your investment portfolio for financial independence, retire early. You see, I have two very inspiring mentors. Okay, one of them is Mr. Lu, Mr. 1M65, Mr. CPF. And he's a really great proponent of topping up your CPF, especially by the age of 30, you should have like 130k so that you can have $1 million by 65 with your partner. And that 1M65 movement actually make a very strong impact on my CPF as well, because I actually do follow that movement and have built my CPF to the full retirement sum by the age of 30. And I think that's quite remarkable, right? But at the same time, Mr. Lu is actually very against the FIRE movement because he felt that if you are considered young, like below the age of 60, you should never retire because you can do so much more for the community and at the same time keep your mind active. And that is a very healthy aspect. If you like retire and do nothing and you just rot away, then your health will fade as well. So that is what he is really preaching about. Okay, people should not early retire at all, and maybe should never even retire because they can do so much more for this community. Now, you see, I have another content creator friend. His name is Kelvin from Kelvin's Learns Investing, and he really supports the FIRE movement, right? But at the same time, he also do not support topping up the CPF. He even made a video about not topping up CPF, and his reasons were liquidity and policy risk. And those are really valid concerns as well. So you can see that Kelvin is actually against topping up CPF because he really wants to put his funds into the best use. And CPF may be too slow for him because maybe like 2.5% OA, 4% SA and MA is not attractive enough for him. He wants to go for like growth, right? Like double-digit percentage annual growth. So those can be in like investments through growth stocks or even in index funds if they are on a bullish years, right? So you see, these are very different viewpoints. I won't say anyone is wrong. Mr. Lu is pro CPF, okay, and he don't like FIRE. Kelvin is pro FIRE and he don't like CPF. Okay, so that's very interesting from these two very influential people. But you know, there's something interesting. In between, there's someone like me, okay? There's someone who is chasing FIRE, more specifically Ikigai, because Ikigai is something different, right? Ikigai is more like what the world needs, what you're good at, what you love to do, and what can make you money. So that's more like the Ikigai, okay? It's not like fully FIRE. It's more like you have a purpose in life, and that is more like a meaningful retirement, okay? Don't call that retirement. That's more like chasing a more meaningful achievement in life rather than rotting away, doing nothing. And you see, I'm also a CPF wealth builder as well because I really reached full retirement sum by the age of 30. And I believe that qualifies me as a CPF builder, right? Because I really do have quite significant funds in CPF. But at the same time, I don't forgo my investments because I do dollar cost average into the market every month 4 times. So in this video, I'll share some very interesting insights on my backstory maybe and talk about FIRE and CPF, my opinions towards each viewpoint. So let's go. I think let's start from my backstory first, right? Like how I started into all this wealth accumulation, financial wealth building kind of yada yada stuff. Yeah, so in 2014, I started my first investments, okay? And I started investing into dividend stocks in Singapore market. So we are talking about telcos, REITs, banks, all these that give really nice dividends, like 5% plus dividends per year. And I always admired that people can have free cash flow coming in like every quarter, every month, like free money, right? At that time, passive income is a really popular term on the internet. I think it still is now, just that people have more focus on growth stocks. But you see, at that time, passive income through dividends was a very popular concept, and that's what I dabbled in first. And that was 2014 before I even graduated. Now you see, coming to 2015, when I graduated and started my full-time employment, that's also the same time when the market kind of crashed, right? Remember the China market crash towards the second half of the year? I thought that it wouldn't affect Singapore stocks, right? But lo and behold, it did. And it was quite devastating to a young fresh grad like myself. Okay, like I suffered from my first very major market correction, and that was quite scary actually. But 2015 was also the first time I got into contact with CPF, because when you started employment, you need to have mandatory CPF contributions, right? Which means that you will deduct 20% from your income and you go to your CPF account by the various allocations. And I start to think, if the government is taking out my money, is it good or bad? So I started doing more research on CPF and found that is just securing my retirement funds, deferring it to a later year. And at the same time, I could get tax relief of 7,000 per year by retirement sum top up. At the time, 7,000. So for 2015, because it's my first year of employment, there isn't much income. So I felt that not the best time to top up for tax relief. That's why 1 year later in 2016, then I make my first CPF retirement sum top up of $7,000 so that I can take advantage of the tax relief, right? And yeah, after that, I continued like yearly, I would do some retirement sum top up or voluntary contribution to MediSave account after I learned that VCMA is much more superior. Then I think 2017, 2018 and even 2019 was quite smooth sailing, right? The market didn't like suffer really great market crashes. It was like bull market year for consecutive 3 years. And just nice in 2019, I secured my BTO flat, which means I got the number. I selected my flat in 2019. So right now it's still waiting for construction to complete. And at the time, my OA has been quite significant because of all the contributions from work, and I started to transfer my OA to SA because I know that I do not need so much OA funds. And the main reason was because I did not choose a very expensive flat, right? I selected a non-mature area. I don't need like the biggest 5-room flat. And I felt that since I do not need so much funds for my house already, my BTO flat, then I can allocate my OA into SA and at the same time build it up to the full retirement sum in the next few years. So that was in 2019. Then 2020 came, you see. 2020, nobody expected a COVID outbreak and the market suddenly plummeted severely in the March 2020 period. And I'm sure some of you could remember, right? If you didn't have holding power, you will just sell out in fear. But suddenly the market just U-turned like after the end of March. So you see, the thing about investing is that it's not always going up one. Like even 2016, 17, 18, 19 must have been a bull year. But 2020, you may be suddenly met with a crash and that may suddenly change your life because you felt that investing may not be for you, because after all these years of accumulating your growth, your gains, and it can just be wiped out within a few weeks. Okay, some of you give up in investing after a few months of years and felt that investing is not for you. But that's okay, right? Because people all are entitled to their own views. And during 2020, I also believe that that's when a lot of people started investing, right? Because they saw the market crash and they start to look at which are the brokers that offers the lowest cost, the best brokers fees. And that comes a message from the sponsor. I want to ask you one simple question. Do you believe in Tesla? Because you have missed the free Apple share, free Microsoft share, and even free Google share in the previous Weibo campaigns. But do you know that Weibo has upped their game again? And this time round, they are giving you $130 worth of Tesla shares. You heard that right? It's $130 worth of TSLA shares. That is the record high. What you need to do is to deposit at least 2,000 Singapore dollars and make one buy order of US stock or ETF. Also, this time round, you have to complete an options trade so you can buy a put or a call option for the short term. And at the same time, maintaining your balance of 2,000 SGD by not making any withdrawal orders for 30 days. And you must be wondering why $130, right? Maybe it's related to the Tesla stock split recently from 1 stock into 3 stocks. So hurry up and sign up for a Weibo account using my referral link down below. Yeah, so if you don't have any brokerage account yet, just sign up for any of these, get the free gift first, then decide where you want to invest. Because that's when you can start out right? Get the positive cash flow gift first, then you can think of which one to use for later. Then coming to 2021, where we actually had a bull market since the start of the year, until November 2021, that was the height of the bull market, remember? And at the height of the bull market, I set my own target of $1 million by 35 years old. I was 30 years old in year 2021, so that means that I had 5 more years to reach that 1 million by 35 target. And you see, I was at the peak of the bull market, so I thought that that could continue for a few years. Lo and behold, just the next month, December, okay, it was a bear month, right? Corrections after corrections. And you thought that the Santa Claus rally was coming, the Christmas rally. Didn't happen. Okay, didn't happen, never mind. Then we come into year 2022. Okay, year 2022, okay, one of the significant milestones was that I reached CPF full retirement sum by 1st January. Okay, because that's when I've actually maximized my top up, my VCMA, my RSTU, okay, and I hit the full retirement sum. So that's the CPF achievement, okay. But the more important thing is the bear market has come. Russia and Ukraine started their war. We had supply chain constraints. COVID was not getting better during that time because of the Omicron variant, and then China is like locking down their economy and all that stuff. So year 2022 was a consistent bear market. Like just when you thought the market was going to reverse, it suddenly dropped back more down. So you can see the path to investing is not always a smooth sailing path. But compared to CPF is like slow and stable. The turtle growth, slow but steady but surely. Okay, but investment is more like lightning. It will go up and down. But on the long-term trend, if you are in index funds, it should go up because companies will continue to innovate to be better for the society. So that was enough of the backstory and how I thought and felt during all these years of wealth building and financial literacy thing. And CPF is really something I felt that is very slow and steady. But regarding CPF, I would say that until you have employment income, then you can start to look at it, because that's when you can offset some of your taxable income through the tax relief strategies like the voluntary contribution to MediSave and retirement sum top up. Okay, so if there isn't any tax relief strategies, I don't think there's an incentive for you to top up and build your CPF unless you really are afraid of investing. Then you can put money in the CPF. So if you're still a full-time student, I would suggest that you can put a little money into index funds investing. I think all these very low-cost brokers offer very good options, and even some of the robo-advisors like Scythe or Scythe Trade, right? Maybe a broad market index fund like the S&P 500 ETF, you can go and put some money into it, like dollar cost average every month, because you don't have to focus on CPF when you are still a student, but you can still dollar cost average, right? Because you have money that you have saved up after all these years, and maybe you want to start investing early. Then when you have gotten your first job, then you can start to look at CPF building, because that's when you actually start to look at tax relief. And I know that fresh grad now earn quite a high pay already, you know. Some fresh grad earn like 5k, 6k from the start. And that's very significant tax relief you could do with CPF. And it's not like you can just do one and not do the other, right? You can do both at the same time. You can build your CPF and chase FIRE at the same time, because CPF tax relief is only like $8,000 a year, okay? The rest of the money, you can put it into investing. You can dollar cost average $500 to $1,000 every month, so that you don't have to time the market, and that's easy on your emotions. You just have to automate it. So really, there's no absolute correct path. I felt that you can do both at the same time. Okay, Kelvin says that you should chase FIRE, not do CPF. Mr. Lu says that you can do CPF and don't chase FIRE. I felt that you can do both at the same time. So which side are you on? I'm curious to hear what your views are. Are you a FIRE supporter? Are you a CPF supporter? Or are you a double supporter? So let me know in the comments which side are you on. But if you really want to learn on how I automate my investments by dollar cost average, then I'll refer you to this video, because it will show you how I do so without any emotions.